A major development in global politics just gave financial markets a sudden boost. The United States and Iran have agreed to a 2-week ceasefire, temporarily easing tensions that had threatened global oil supplies and pushed markets into panic. The deal reportedly includes reopening the Strait of Hormuz, a narrow waterway through which about 20% of the world's oil shipments pass, making it one of the most important energy routes on the planet. The moment the news broke, markets reacted instantly. Oil prices dropped sharply. Brent crude fell roughly 13–16% to around $92–94 per barrel, while U.S. crude also plunged below $100. Stock futures jumped as investors celebrated the possibility that oil supplies will keep flowing and the conflict might cool down. But outside the markets, public reaction is far more divided. Some people say the markets may be cheering, but they believe Iran gained the upper hand by controlling the strait and forcing concessions. Others are frustrated that thousands of lives were lost in the conflict, yet headlines focus mainly on stock market gains and retirement accounts. Some critics even call the situation one big political grift, while others say the ceasefire proves diplomacy worked and prevented a much larger war. A few commenters remain cautious, warning that the Strait of Hormuz could stay dangerous for shipping for a long time. To understand why this matters, look at the numbers. When tensions escalated earlier this year and oil shipments were threatened, crude prices surged from roughly $64 per barrel in February to over $116 by late March, a spike of nearly 60%. Historically, similar geopolitical shocks, like the Gulf War or major Middle East conflicts, have caused sudden oil spikes that later reverse when tensions ease. Today's sharp drop in oil prices suggests investors expect supply to normalize. But since this ceasefire is only temporary, volatility could return quickly if negotiations fail. For the average American, the biggest impact is energy costs. If oil prices remain lower for the next few weeks, gasoline prices could stabilize or even fall, easing pressure on household budgets and inflation. Lower energy costs also help businesses, from airlines to trucking companies, potentially reducing prices across the economy. Still, experts say people shouldn't assume the crisis is over. A temporary ceasefire means the next 2 weeks are critical. If talks collapse, oil prices could surge again just as fast as they dropped. For now, practical steps include keeping an eye on fuel prices, avoiding panic financial decisions based on short-term market swings, and staying informed about developments in global energy supply. In simple terms, the markets may be celebrating today, but the real question is whether this fragile pause can turn into lasting peace.